Hello again. We're going to be staying with Learning Outcome 3-4, and we're going to be concentrating in this third mini lecture on liquidity ratios. But before I get to that, I forgot to tell you to add something to your notes. When we were talking about the profitability ratios in the previous mini lecture, please put times 100 for both of those ratios because they're usually represented as a percent. Now, with all of these ratios, whether you know you're doing well or not results from a comparison. First, comparing yourself with yourself from a previous period. But you can also benchmark or compare yourself against other companies. And what you'd like to do is to compare yourself to the best in your field or your industry. The other thing is that some ratios are dependent on things other than other companies. For example, when we talk today about the days to collect, whether your ratios are good for your receivables turnover or days to collect depends on your credit policies. And whether you're doing well in your inventory or days to sell depends on the type of company that you're in. So overall, we want to remember that it's important to do all three types of analysis: horizontal, vertical, and ratio analysis, and then also to compare yourself to your previous performance, and then to benchmark or compare yourself against the best in the business. Okay, so let's talk about liquidity ratios. On page 5, liquidity ratios are described as ratios that relate to a company's short-term survival, and in particular, the company's ability to use current assets to repay current liabilities as they become due. And as with the other ratios, you're familiar with these already. The receivables turnover and days to collect were learned both in Chapter 8. The receivables turnover takes the net sales revenue, and truly they mean the net credit sales revenue, because if you already got paid, it wouldn't be considered a receivable. The net credit sales revenue and divide by the average net receivables. Now, in both cases, for the numerator and the denominator of the fraction, we see the word net. And when we see the word net, that means that something's been subtracted. So what's been subtracted from sales revenue? Well, your returns and allowances and your sales discounts. What has been subtracted from receivables or accounts receivable to get to net accounts receivable? Well, if you recall from Chapter 8, that would be the allowance for doubtful accounts. And again, they want an average here. So you would take the end of last period, or perhaps even last year's balance of accounts receivable, and it would be net the allowance, and then add the end of this period's net receivables, add them together and divide by 2. Most often we're talking about year-end data. So the accounts receivable turnover indicates how frequently accounts receivable is converted to cash during the year. And then we take that accounts receivable turnover and divide that into 365 to get the number of days on average it takes you to collect your accounts receivable. Whether these ratios are good for your company or not depends on your credit policy. If you have a credit policy of collection within 30 days, then the number of days you want to collect it would be 30. You would want the days to collect to be 30 or less, because the sooner you get your money, the better, because then you can do things with your money. Invest it or buy more inventory and sell it again. The receivables turnover we want as high as possible. The more quickly you turn over your accounts receivable, which means to collect on it, the better. So if there are 12 30-day periods in a year, or 12 months in a year, then you would expect a receivables turnover of 12 or more if your credit period is 30 days. Let me say that again. If your credit period is 30 days, then there are 12 30-day credit periods in a year. So you would expect your receivables turnover to be 12. It would even be better if it were more. And since your credit period is 30 days, you'd expect the number of days to collect would be 30 or less. So you want the days to collect to be a shorter number of days or smaller number, and you want your receivables turnover to be as high as possible. These are both also a measure of how well your accounts receivable department is doing and your credit manager is doing. Because if your credit manager is extending credit to people who don't deserve it, then it will show up in your receivables turnover and days to collect. And if your accounts receivable clerk is not pursuing collections, then it could show up here as well. Now let's take a look at the inventory numbers. We've got inventory turnover and the days to sell, and we learned both of those in Chapter 7. The inventory indicates how frequently inventory is bought and then sold throughout the course of the year. And these ratios depend more on the type of industry you're in. For example, you would expect a grocery store to have a high turnover, to sell its inventory more quickly than, for example, a jewelry store, because in a grocery store your product is perishable, and so it's usually bought in small quantities and then sold quickly. Whereas in a jewelry store, since it isn't perishable, the sales would occur more slowly. And also, jewelry is more expensive, and it's not something you need to live, whereas with food you need to be able to eat, so you go to the grocery store more frequently than you would go to the jewelry store. So a grocery store would expect a higher turnover and a lower number of days to sell, and a jewelry store would expect a slower turnover and a higher number of days to sell. These ratios depend on the type of business that you're in. Again, they're asking for an average number. Here they're asking for average inventory. So end of last year and then the end of this year, add them together and divide by 2. We take 365 and we divide the inventory ratio into that, and that tells us the number of days on average it takes you to move your inventory. And finally, the current ratio, which we learned back in Chapter 2, that compares current assets to current liabilities, and it measures the company's ability to pay current liabilities using its current assets. And we look for a ratio of about 1.5 to 1 on that. So we're going to take a look at a problem now. We're going to be working on E13-7. And this is found in your worksheet as well. I've taken the liberty of providing the formulas here for our inventory turnover and our accounts receivable turnover. Okay. Our problem states Double West Suppliers reported sales for the year of $300,000, all on credit. The average gross profit percentage was 40% on sales. And here are our accounts balances. We've got net accounts receivable, the beginning and the end of the year, and then inventory, the beginning and the end of the year. And let's first of all compute our inventory turnover. We need to find our cost of goods sold and divide by the average inventory. Well, the cost of goods sold is going to be a challenge because they did not give us the cost of goods sold. However, if you remember back in Chapter 6, if we take our sales and subtract the cost of goods sold, we get our gross profit. Now we know that the sales are $300,000. They don't give us the cost of goods sold, but they do say the gross profit is 40% on sales, which means if we take $300,000 and multiply that by 40%, we'll get the amount of gross profit, which is $120,000. Now you can solve for the cost of goods sold. 300,000 minus something equals 120, and that something is 180,000. You can also solve this algebraically as well. You can say gross profit equals 40% times sales, get it that way, and then solve for the cost of goods sold, or conversely you can say if gross profit is 40% of sales, then cost of goods sold must be 60% of sales. And if you multiply 60% times 300,000, you get 180,000. That's if sales are set to 100% and gross profit is set to 40%. See, that would show 60% of sales is cost of goods sold, and you would simply then measure 60%. You would multiply 60% times 300,000 to get the 180. Okay, so let's do this now. Let's take our cost of goods sold of $180,000 and divide by our average inventory. Well, they give us two inventory figures, but we don't have the average. So if we add them together, that would be $100,000. And then if we divide by 2, our average inventory is $50,000. And our inventory turnover is 3.6 times. Our inventory is sold on average 3.6 times a year. While we're working on inventory, let's go to our days to sell. The days to sell formula is 365 divided by our inventory turnover of 3.6 times, and that gives us 101.4 days to sell our average inventory. Now let's take a look at the accounts receivable turnover. Our net credit sales, they told us, were $300,000, and we need to figure out our average net accounts receivable. So let's do the same thing. Let's add the beginning and the ending together, and that equals 100,000. And then you can divide by 2, and that gives us again $50,000. So our accounts receivable turnover is 6 times a year. We collect our average accounts receivable 6 times a year. So how many days would that be? Well, let's take 365 days and divide by that 6 times, and we get 60.8 days it takes to collect. Now that's a very long time. But if your credit policy is 60 days, then you're pretty close. You're almost on top of it. However, if your credit policy is to collect within 30 days, then you're a whole month behind on your collections. Now, while we're here, I want to point out one more thing. Another way you can use these ratios. After buying inventory, it takes the company 101.4 days to sell. Then it takes Double West suppliers 60 days to collect their money after they sell. So that means in all, you are waiting 162.2 days to get your money. That's more than 5 months. So this is another way you can use those two ratios, days to sell and days to collect, to find out how much time will be elapsed between the time you acquire your inventory and finally collect on it. And we're all done with our demonstration problem. We'll see you in our next video.